Today, we're cracking the code on Buffett's timeless investment strategies and showing you how to apply them in today's market. Get ready to build wealth like the Oracle of Omaha himself. 1. Look for a margin of safety. Buffett's golden rule: buying stocks for less than they're truly worth. This margin of safety acts as a financial cushion against potential losses. Imagine buying a stock for $10 when the underlying company's assets are realistically worth $12. That $2 difference is your buffer zone. Even if the stock price dips slightly, you're still protected because the company's strong fundamentals should prevent a significant decline. This philosophy is key to Buffett's success. He believes overpaying for a stock, even a good one, can erase years of future profits. As he famously said, a too high purchase price for the stock of an excellent company can undo the effects of a subsequent decade of favorable business developments. In simpler terms, even a great company can't overcome the burden of being bought at an inflated price. 2. Focus on quality. Buffett avoids bargain bin businesses. While a struggling company might seem appealing because of its low price, he focuses on investing in strong, established companies with a proven track record. This aligns with his famous quote, "It's better to buy a wonderful company at a fair price than a fair company at a wonderful price." Before I continue, if you're new here, please hit the subscribe button so you make sure to never miss my weekly videos on wealth creation tips. 3. Don't follow the crowd. Buffett offers two crucial pieces of advice for new investors, especially relevant in today's social media-driven world. Don't blindly follow the crowd. Just because a stock is trending on Reddit doesn't mean it's a good investment. Don't be a contrarian for the sake of being different. Don't sell good companies simply because others are buying them. Instead, focus on finding valuable investments regardless of popular opinion. He emphasizes that controlling your emotions is key to successful investing. As he said, the most important quality for an investor is temperament, not intellect. You need a temperament that neither derives great pleasure from being with the crowd or against the crowd. In simpler terms, avoid making decisions based on emotions and stick to your research and long-term strategy. 4. Don't fear market crashes and corrections. Basic investment strategy: buy low, sell high. Simple, right? Not quite. Our emotions often throw a wrench in the plan. We see friends making a killing and feel the fear of missing out kicking in, pushing us to invest even when the timing isn't great. On the flip side, when the market takes a nosedive, our natural instinct is to bail ship and cut our losses, potentially missing out on a rebound. Enter Warren Buffett, the investing legend. He welcomes market downturns because they create buying opportunities. Think of it like your favorite store having a massive sale, 20% off everything. You wouldn't panic and run away, would you? You'd probably grab a cart and load up on bargains. That's exactly how Buffett approaches stocks at a discount. As he famously said, opportunities come infrequently. When it rains gold, put out the bucket, not the thimble. In simpler terms, don't let emotions dictate your investment decisions. Instead, focus on finding and capitalizing on well-researched opportunities, especially when others are running scared. 5. Approach your investments with a long-term mindset. Buffett's golden rule: think forever, not today. He famously said, if you wouldn't own a stock for 10 years, don't even touch it for 10 minutes. He's not in it for quick flips. He buys like he's buying a business to own, long-term. While he does sell sometimes, his mindset is usually forever. Can't commit to forever with stocks? Following Buffett's advice, consider a set-it-and-forget-it option like an S&P 500 index fund. It's a great option for those who prefer a long-term, hands-off approach to investing. 6. Don't be afraid to sell if the scenario changes. Remember, even the best investors know when to cut their losses. When asked about an investment he sold at a loss, Buffett famously said, "The most important thing to do if you find yourself in a hole is to stop digging." He strives to hold stocks forever. But sometimes, circumstances change. Case in point, decades ago, Buffett bought shares in Freddie Mac. However, red flags emerged as management took on unnecessary risks. He recognized the danger, sold his position, and avoided significant losses during the 2007 to 2009 financial crisis. Lesson learned: don't be afraid to sell if the situation changes. While holding long-term is ideal, adjusting your portfolio when things go south can be crucial for financial success. 7. Learn the basics of value investing. Imagine buying a valuable watch for just $50. That's the essence of value investing, a strategy mastered by legends like Warren Buffett. Instead of chasing the hottest trends, value investors focus on finding companies that are like that discounted watch, undervalued compared to their true worth. They believe the market eventually corrects its mistakes, recognizing the company's actual value and causing the stock price to rise. This means buying low and selling for potentially much higher down the line. In simpler terms, value investors are like treasure hunters. They dig deep, searching for hidden gems in the market, companies with great potential trading at discounted prices. They believe in buying quality at a bargain, waiting for the market to catch up and reward them with long-term profits. 8. Understand compounding. Imagine turning $1 into $3,641,613. That's the magic of compounding, and Warren Buffett is its master. He uses this strategy, where earnings and dividends are reinvested, to grow his wealth exponentially. Since taking over Berkshire Hathaway in 1964, their average annual return has been 20.1%, compared to the S&P 500's 10.5%. While these percentages might seem small, the power of compounding works like a snowball, gaining momentum over time. This resulted in a 3,641,613% total gain for Berkshire shareholders, compared to just 30,209% for the S&P 500. 9. Research and reflect. Forget the bustling Wall Street image. Contrary to popular belief, Warren Buffett's days aren't filled with non-stop activity. In fact, he spends a significant portion of his time in his office simply reading, reflecting, and thinking. This might surprise some investors, but Buffett himself has said, "I insist on a lot of time being spent, almost every day, to just sit and think." He views knowledge as a compounding asset. Meaning the more you learn and reflect, the greater your understanding becomes over time. In essence, Buffett believes his success stems from dedicating significant time to acquiring and building upon his investment knowledge. So, there you have it. We've explored some of Warren Buffett's timeless principles and how you can apply them to your own investment journey in today's market. Remember, investing is a marathon, not a sprint. By embracing these principles, conducting thorough research, and maintaining a long-term perspective, you can become a more informed and confident investor on your path to achieving your financial goals. Investing involves risk, and past performance is no guarantee of future results. Always do your own research and consult with a financial professional before making any investment decisions. I hope this video helps you in being one step closer to your financial goals. Please give a thumbs up on the video if you have enjoyed watching. If you have any questions, please leave them in the comments below. And be sure to subscribe to my channel for more wealth creation tips. I'd see you in the next video. Bye.